Hey everyone, Monica Jazik from RPI Education, and welcome to the Financial Freedom Summit. In this series, you'll hear from 21 experts sharing powerful, little-known wealth building strategies that 98% of people are not using. These interviews are packed with real actionable steps to help you fast track your financial freedom. So let's jump in with today's guest, Nick Lequier, owner of Mortgage Wellness. Nick, how are you?
I'm great. Thanks so much for the invite, Monica. Really happy to be
Oh,
here with you today.
love having you, Nick. I'm going to just have a quick
Thank you.
bio I'm going to read to the audience
Sure.
of you here. So today we are joined by Nick Lequier. Nick is an accomplished entrepreneur and a mortgage broker and the founder of Mortgage Wellness, where he, his partners, and their team have helped thousands of Canadians secure financing from buying their very first home to arranging complex cottage and private mortgage solutions. Nick is also a real estate investor himself and a dedicated family man, bringing both professional expertise and personal experience to every conversation. Beyond finance, he's a community builder and innovator, always exploring new ventures and ways to bring people together. We're excited to dive into his insights on real estate, entrepreneurship, and creating opportunity. Welcome, Nick.
Thanks
Love
so
this
much for having me,
bio.
Monica.
I
Yeah,
love
no,
this
thank you.
bio. I love how you include the family in
I'm a big
there.
family guy. I mean, when I'm not doing mortgages, I'm at home. We're in hockey rinks, we're on the ski hill, we're cottaging, just I feel like, the business life that we've built feeds the personal life. But likewise, like my personal life feeds right into my business life. Like you'll catch the kids in the office, you'll usually see my wife sort of flying in and out of the office. It's a good balance that we built.
It really is. And I think that's really important for entrepreneurs, especially entrepreneurs like yourself. You created such a successful company that
Thank
I've
you.
used many, many times,
Thank
thanks
you.
to
Yes, thank you,
the
Monica.
Mortgage Wellness. And you've
Thank
always
you.
done a great job. You serve us, you serve our clients. But you kind of built it with, the end in mind, which is really family is everything. That is your sort of time, money, freedom. Freedom is family. And then also included a lot of your employees sort of as part of being owners as well in your business, which is really interesting business concept.
Yeah, we did an employee share ownership plan about 3 years ago. So there's five of us, four of our key staff were invited in to be owners in the company. So we have a lot of fun running Mortgage Wellness now. We have a really great partnership group. We have a really great culture internally. Honestly, we just have a lot of fun doing what we're doing. We have great clients. We have great referral partners like our real estate network, builders, financial planners, lawyers, and that sort of thing. So we come in, we have a lot of fun, we help a lot of great people every year, and again, just really enjoy what we do.
Absolutely. And I think that's important because so many people just work, work, work. They're not creating that sort of family environment. And really, where is the fun? If we're going to spend so much time working, we may as well enjoy doing it and also making a difference in other
I mean,
people's lives.
totally. And the added benefit, selfishly, of course, is I love real estate. As you know, I love investing in real estate. So knowing what I know about how to find money and how to finance real estate is super helpful, in my personal enjoyment of real estate because it allows me to, acquire property. I know where to look. I know how to finance it. I know how to do it quickly. So it sort of, feeds one of my other enjoyments as well, which is real estate investment.
Amazing. Well, let's get into the questions here and let's
Sure.
talk about this wealth building strategy that you use to create financial freedom in your life that most people do not use because that's what we're focusing on. And why do you think it is so underused?
So I think what I'll do, Monica, is I'll answer that both for myself and for my
Mhm.
clients because I sort of practice what I preach. So, you know, when a client comes into my office who's just looking to get a mortgage, we're always talking about like what what else? Like what more is there for them? So we start with the really basic question of like, do you have any interest in owning more real estate or investing more in more real estate? And a lot of people, quite frankly, as you know, just don't have interest in that, and that's fine. If that's the case, we find them the best mortgage product and mortgage strategy for them for their family. But if the answer is yes, oh my gosh, like I've always wondered if we could own more property and invest in real estate, and especially before the last 3 years, right, with the downturn in the economy and the real estate market, the answer was surprisingly mainly yes, right? So what we do is we start with the rule of five, and the rule of five, you've heard me talk about this before, Monica, is Generally, most banks will allow you to own up to five properties. Now, that can be a combination of, your primary residence, your cottage, and three rental properties, or your primary residence and four rental properties, or your cottage, your house, a house for your kid who's going to university, and two additional rental properties. But the first five rental properties to acquire is generally fairly easy. And the way that we do that is just through leverage. So the wealth building strategy is just there's no secret. It's to like master the basics. Okay, you own a home. How much equity do you have in your home? How much accessible equity do you have in your home? So that's 80% of your home's value. You own $1 million home, you can borrow up to 800,000. How much do you owe currently? 500,000. Well, that means that theoretically you could borrow 300,000. What is 300,000 20% down on, right? And then we start to sort of reverse engineer the numbers, as you see, to say, okay, well, how much real estate can you purchase? Is $300,000 20% down on one home, two home, three homes, five homes? Like, depends on what you want to buy and where you live, of course. But the key strategy here is just it's leveraging existing equity to multiply the number of homes that you currently own or you could own. And then obviously through time and through appreciation and through hard work and through principal pay down, that property portfolio could theoretically expand. It could expand from two houses to four houses to five houses. Usually most small investors, sort of want to limit their investments to a handful. Now, crazy people like you and I and a few of our friends want more than that, and that's okay. There's strategies for that. But on the most basic level, myself, my clients, we show them how to start with the first investment property, perhaps the second investment property. Let it sit, let it nest, let it do its thing, and let's revisit this in 3 to 5 years.
I love that. And that's what I love doing is sending clients to you and being like, you're going to meet with the mortgage wellness team. They're going to show you how to build a mortgage plan
Yeah.
because it's really, really important for people not to just buy a house and then figure out what to do, go to the next one, figure out what to do. If you guys could tap into a mortgage specialist and then really build that mortgage plan, it really, really heightens your success. And I absolutely love the fact that you do that. You're kind of like helping achieve goals and, like you said, reverse engineering it. So
Yeah.
that's amazing.
And just starting with the end in mind, like
Mm.
really dispelling the myth that like owning more real estate is not impossible. Let's just figure out how you do it.
Absolutely. Like, and I love that. Begin with the end in mind. That's a really good financial freedom sort of thought as well. I think people feel so limited in what they can do that they focus on the how and not on the what. So if
Yeah.
people were to come to you with a valid question and say, Nick, my job or so my dream really is to own a 200 unit apartment building all by myself. And I currently have $250,000. So I know I can't do it now, but what do I need to do to get there? Is
Yeah.
this something the mortgage wellness team could help really make some of
Like
these reality?
I bet you we had 10 of those meetings yesterday because you see, everybody in this market, in this economy, knows if they're looking at real estate investment, knows that there's opportunities and low hanging fruit that exist in this market. They want to know how to acquire them because what they also know is that this market, this economy, this real estate market specifically won't be like this forever.
Mhm.
It's going to change. Now, it's not going to change in a year. It may not change in 3 years, but at some point in the not so distant future, this real estate market is going to change. So, how can I buy in this economy and then wait and multiply my wealth, multiply my equity into something where if I do sell, that 200 unit apartment building is that much closer to being actually attainable? Right. So one example is I met with a young guy yesterday. You know him actually. It was an introduction from yourself. Finishing up, a renovation and a flip of his personal home. And he's like, what else? Like, what else? And we had that exact conversation. It's like, I don't know how many times you want to like flip to others in this market. Think about that as a concept. Like, you buy the home, you put in all the work, you renovate it, you put it up for sale, and then you wait. You
Mhm.
wait in this market and you sell it for what we know is a lower price than it would have been 3 years ago, and arguably a lower price than it probably will be in 3 years from now.
Hmm.
So with that in mind, why not flip to yourself? Like why don't we go back to basics and say, can I execute a traditional BRRRR methodology, right? A traditional BRRRR strategy where I acquire, I renovate, I refinance to myself, keep it, and move on to the next one. Because the market that we're in right now is such that, like, if you acquire, like, it's a buyer's market. Like, I mean, let's ignore the actual statistics of months of inventory on market and everything else in different communities. It is a buyer's market. Like, I mean, there's low hanging fruit. Now, let's go back to 3 years ago when us as real estate investors are like, you can't buy anything
Hmm.
because they sell too fast. I can't get my financing in order. The numbers don't make sense. The property sells for too much. There's existing tenants that I have to take over because it's a seller's market and they got to dictate. Now it's a buyer's market. So the key is buy within reason, like smartly, safely, with strategy, but buy, renovate, keep, wait for the seller's market,
Yeah.
and then strategically offload those assets when it's right for you,
Hmm.
right? Because if you're flipping to the market right now, even if it's your primary residence, you've been there for a year and a half, look what you're selling into, So change your strategy a little bit, acquire in this market and wait. The person that wants to eventually move towards the 200 unit apartment building, for example, Monica, like, think if that person in Barrie bought, I'll just say hypothetically, if they had a lot of money, they bought 10 $500,000 townhouses today,
Hmm.
okay, and just rented them out. Let's ignore all the other variables like what they rent for, what they cost. Let's just assume they cash flow. This person has some money to facilitate 20% down on 10 $500,000 townhomes. Those townhouses were touching $800,000 at the height of the market. So that's a $300,000 potential lift at some point in the future.
Absolutely.
So, that's $3 million.
Hmm.
So, 5 million bucks to acquire, and that's 20% down is $1 million.
Yep.
They get their $1 million back, plus they get $3 million on top of it. Now, after paying real estate commissions, closing costs, some capital gains, and everything else, they probably have enough to put down on the 200 unit apartment building.
Hmm.
So, in this market, like, again, like, it's so easy to focus on the basics. And the basics are good properties, good assets that will appreciate, and maybe like a traditional burst strategy.
Hmm. I think the burst strategy, that's my favorite strategy. And for those audience, the burst strategy stands for the buy, the renovate, the rent, refinance, and then repeat. Now,
Yeah.
the refinance, we're pulling a large sum of money out. And this alone can create financial freedom for people, this use of strategic leverage. And let me explain what my theory is too. Even if you want to have one real estate investment property and you want to diversify wealth in other ways, there's no other investment out there that can give you that amount of capital quickly, unless you have a stock win, a
Hmm.
very, very sporadic stock win, or a crypto win. And we've all seen what crypto does as well. Crypto can be great, but I mean, it's not like real estate, which you really can plan out. Even in today's market with appraisals coming in low, you could take that worst case situation and really even plan for that and how much money that you're able to pull out. There, we have members that are pulling out anywhere from 250,000 to $500,000 from these types of burrs and still able to hold this asset and own it. And at the new mortgage rate, it's cash flow positive every month and they're safe. They could take this money and give it to a high-end wealth advisor at RBC or at one of the banks. And I'm not talking about the set it and forget it thing. I'm talking about someone who will not look at you until you have $500,000 to $1 million in your book and then monitor it if that's what you want with your life. This really elevates you into the top 2% and to get that attention because those wealth advisors are not setting it and forgetting it. They're watching, they're monitoring, they're maintaining that for you because they're getting a cut of that. So they want you to be making money. So people don't understand how powerful like that burr is. And even in order for you to take that same money and put it into your insurance policy, if you're doing the infinite banking concept, you've just increased your insurance amount, for estate planning substantially. So I absolutely love the BRRRR, or like you and I do, we use it to buy another property, right? And then we keep adding to it. Or you could even have freedom in your life and pull off the money and live off of it for a year if you had a job layoff. So I think it's so powerful, Nick. I totally agree.
It's super powerful. And with the somewhat depressed real estate market right now, even for burrs, like the name of the game is to try and get your initial capital and rental money back.
Hmm.
Check. Okay. If I can't get my initial investment, my rental money back, how much of that can you get? And when we really quantify that for people sometimes and say like, okay, let's step back. You buy this house. What Monica, I could tell you could buy this $600,000 home with $25,000 down. You'd say I'm in.
Hmm.
Okay, well, that's what it's going to look like. You might have to leave $25,000 in the project because of the lower appraised values, for example, at the end right now. Most investors are okay with that. But we also have mutual clients who are real estate investors who are hitting big wins, meaning getting all of their initial investment out on the refinance, plus all of their renovation money out on the refinance, plus some extra money to go to the next project. You
Hmm.
just have to do it properly. Like, for example, for a long time, ADUs and third units were very popular, right? Now, to build a carriage house in a backyard is arguably 250 or $300,000.
Hmm.
Do you get the lift on that? I'm not sure if you do. For
Hmm.
example, currently in Barrie, there are legal duplexes with coach houses in the back, resale for $800,000.
Hmm.
Holy smokes, right?
Hmm.
$800,000. So take off the $300,000 that it would cost you to put in the ADU. You're at 500,000. It has a legal basement apartment. How much is that? 75 or 80 grand probably. So really what you're doing is you're buying the house for 400,000 that somebody put in 75 to the basement plus 250 or 300 to the backyard, and you say to yourself, "Well, I can't buy that house and manufacture that product myself right now." So, like if you can buy it resale for less than it costs you to do, you buy it resale, right? Maybe that's not the strategy then right now is to add the ADU. Maybe the strategy is to just focus on the basics, like take a beat up bungalow in Aurelia like my client just closed on yesterday that they bought in the 400s, duplex it. So they'll put $140,000 into it. Maybe they'll be into it for 640, but the house will be worth seven and change when it's done. Do the refinance, calculate how much will be left in the property, and say to yourself, am I okay to leave that much money in? So again, like, rolling all the way back to your question about financial strategies, I find it's the basics that work right now. It's like identifying the key opportunities. The BRRRR strategy is perfect. I mean, but heck, like think about this, that, one of these 3 unit properties in Barrie that can be purchased for $800,000 currently. I mean, if there's if there's an investor that just wants a passive investment, maybe they don't want to do what we do and tear a house apart and deal with all the permits and everything else. At 800,000, if they have $160,000 in home equity that's available on a line of credit, I can almost guarantee if you purchase that home using the 20% from your home equity line of credit, put it down on this home and just rent the 3 units and take care of it, wait for the market to rebound, recover, and increase. I mean, like you remember those 3 unit properties in Barrie, right, Monica? We
Yeah.
were we were appraising those at over $1 million,
Yeah.
$1.1 million. So just, the most simple, the most basic real estate strategies are now the ones that we're seeing, are probably the best in this market.
Absolutely. Make money when you buy, and there's so many like properties available to buy. Buy
Totally.
and then hold for sure.
Yeah.
So, what were you doing to build wealth before you started, using mortgages,
Mm,
real estate investing, all this sort of stuff, or even starting mortgage wellness? And what was
yeah.
this pivotal moment that kind of happened in your life when you knew that you wanted to make a change?
So I went to college for marketing, sales, that sort of thing. I had a really great group of guys that I was friends with. They're still my very best friends today. And we were all sort of after sales careers. So getting into college, I landed my first sales job. Locally here, big brand and nationally. And I was like a territory manager. And then I was, sort of worked my way up through that company. I was young. I was the youngest guy on that sales force. And my boss at the time was, he was my first business mentor. He had gotten into the mortgage business and sort of, was telling me all about it. So he was my introduction into the mortgage business. We're still great friends today, and he's still in the mortgage business. But getting into the mortgage business also fed again my passion for real estate. So in my early 20s, somehow I had read Rich Dad Poor Dad, and that was everything for me. I remember actually working for, and so I worked for Coca-Cola at the time, and I remember going one step deeper and reading the cash flow quadrant and thinking, I don't want to go to work tomorrow. Like this book just totally opened my eyes. I'm like, I don't want to go trade my time for money tomorrow. But that segue into the mortgage business allowed me to, you know, trade, instead of trading time for money, I was trading effort for money. The harder I worked, the luckier I got, right? And that continued every year. But what's really interesting is along the way, I always, I started buying real estate right away. Like my first year in the mortgage business, we bought our new big house for our family, plus I'd bought an investment property, and we just kept on buying. I'd say by like early 30s, maybe we had like 8 or 9 investment properties.
Mhm.
We sold them all, built our big family home, and you've heard this story. I almost went broke building that home, like thinking I could build a home. Like, what do I know about building a home? We were crazy over budget. We didn't have money to finish the grass when we were done, lived in a football field for 2 years. But, time heals these kind of wounds. And as that home went up in value and we started making more money in the mortgage business, we started reinvesting into real estate. And that was 10 years ago, sort of thing. So we built up the portfolio handsomely, and we're still in the same home and that sort of thing. But I'd always bought real estate. And here's one great example. When we were running Mortgage Wellness, we were leasing the top floor of a converted church downtown Barrie. And you've been to the building. We ended up buying that building. The
Mhm.
the gentleman that owned that building, he was out. He sold us the building, held the vendor take back in second position. I think I put $100,000 down on the building. It was huge. It was like 10,000 square feet, and it came with the house next door too. And it was like, $1 million sort of thing. Now, we sold that building at the height of, the pandemic, COVID, and everything else. We sold it in a week, and I thought, who's going to buy this building? Like we had like 40 something offices in it. It was way too big for us, but we solved somebody else's problem. I remember the buyer who went through that building. I overheard them say, I don't know if it's big enough for us. Huge company who was downsizing, right? They didn't need as many offices either, but they had 100 offices and they needed 40.
Mhm.
So I thought that was really interesting as well, like solving somebody else's problem that's maybe not the same as my problem. But, really the story here and, sort of the overarching sort of theme here is when we sold that building, Monica, we'd owned it for a little less than 10 years, but let's call it 10 years. Okay. If I look at what I made on that building over the course of 10 years and I divide it by 10 years, I made more per year on that building than I did in personal income running my mortgage business in that building.
Wow.
I put my key in the door every morning at like 6 a.m. I mean, my 30s, mainly my 30s. I worked 6 days a week, 12 hours a day. 6 in the morning. I mean, probably more than 12 hours a day because, like, I would leave at 8 o'clock at night. My wife would bring the kids down and have dinner with me at the office. I put my heart and soul into that business and I still do, but like not like those years. And if I if I looked at what that building made on a per year basis in my early days, I wasn't making that. And even in my most successful days, like later, I was probably maybe just making that. But this building just sat there, appreciated. The mortgage got paid down, and then over time, it paid me.
Mhm.
So that was an incredibly valuable lesson. I mean, I couldn't have one without the other. So I'm grateful for both.
Mhm.
But can you imagine if I would have leased a space that whole 10 years?
Yeah.
I just, the money that we made from the sale of that property, it wasn't life changing money, but it was certainly life altering money,
Mhm.
and it allowed us to do other things. Buy more real estate, pay down our own mortgage, use that equity to then re-leverage and make it tax deductible on another mortgage investment, that sort of thing. These are the same strategies that we share with our clients every day, but it's just the key is knowing what's out there, what's available, right?
That's amazing that you say that because it's like for financial freedom and people who are business owners and they are renting out a space, it really is sometimes that you're better to rent than to own. But like you said, if you're in this for the long haul and your business does need a space, by owning that space, that is not trading time for money. You need a place, it's kind of like your house. Why
Hmm.
rent a house? You should own it, not so you can own things, but you got to live somewhere. How can we take this liability and turn it into an asset? And
Yeah.
it makes sense tax wise, it makes sense business wise, and it goes down to everyone needs seven streams of residual income. So for two of them for you, one, mortgage wellness, running your business income, which still is trading time for money. And then there's two, your real estate, which I will never call real estate as totally passive. It's not passive. It's always an active
Hmm.
investment to a certain extent, but that was passively building wealth for you in the background. And it really was one of those hidden superheroes of
Yeah.
wealth builders. So anyone out there that really is an entrepreneur to have that sort of office space where you have that type of ownership, you just have to make sure it makes sense. I loved your church. I thought it was a really, really interesting.
Very cool. We miss it a lot, but we
But
didn't
tell
need
them what
it.
you did, that you went to a next strategy. And you also noticed, I'm eating dinner with my kids here. Being an entrepreneur is never perfect. We often
No.
trade in 9 hours or 6 hour days to 16-hour days and make a quarter of the money.
Yep.
But we
Yep.
have that freedom.
Spend
And
a
if you
lot of
have the
years doing that.
freedom,
Yep.
having dinner with your family at the office, that's okay. We've all been there. It's really about, I love how you recognize that, took that back to the whole concept of what mortgage wellness meant for you and restructured the whole ownership. So now you can schedule your own time, your own money and freedom because you have a lot of great time. Whenever I talk to you, a lot of time you're like, I'm with my kids. I'm away for the weekend. I'm doing this. And it's amazing. And your team, you've created this whole team of amazing mortgage agents that are just as invested as you are.
And honestly, like the company wouldn't be what it is without them, So like I never worry about who has my back or if, I need to take off and do something with the family or whatever. My team allows me to do that. Like similarly, my team in real estate, like I have a full-time person that supports me in my real estate portfolio. Um, and when you have these great people around you, it allows you to do even more great things, right? But certainly as an entrepreneur and being within mortgage wellness, I mean, it serves all aspects of my life. It allows me to invest in real estate. It allows me to have great people around me all the time. I get to meet with like just wonderful people who want time and advice and great service every single day. The clients you send me, the clients that our other partners send me, I have a lot of fun with those clients. And of course, the other benefit is an entrepreneur. So I get to have a somewhat flexible schedule. Now, I'm my own worst enemy. I sometimes fill that time up with like, I sit on the board of our minor hockey association. I'm the coach, or pardon me, the manager to the coach of my kids' hockey team, and all these other things, right? That I like really have no time for. But when I step back and look at it, I'm like, I get to do these things, right? I'm
Mhm.
thankful that I get to do these things because I'm an entrepreneur in many ways. I'm a real estate entrepreneur. I'm a business entrepreneur. I'm just really grateful for those things.
Yeah, those things really are like the most important things. And those are the things also that you really do remember. And they're
Hmm.
also things that your kids remember because they'll remember you showing up. They also remember eating dinner at your office and they'll probably laugh about it one day. Remember the
Yeah.
time we used to come to your office and eat at your office? Haha.
Yeah.
And now, thank God,
Absolutely.
here we all are. But they also remember when you get to be there. And we can't be at every last thing. Some days you can't. But for the majority of things, entrepreneurs have that sort of freedom to make their schedules. And I think that's a really important thing of time, money, freedom. And you
Yeah.
really kind of get a little more control over things when you notice the gaps in other areas of your life. So you kind of talked to us already about the five property strategy and how you're getting sort of things, how people can use the five property strategy to fast track their wealth in life. Do you have an example of how you use this strategy of exactly what you kind of started with to fast track your wealth building?
Yeah, you know, it was like going back to our early days when we were just trying to use whatever free cash and equity we had to just buy more properties. I would apply the same strategy today, especially in this market for sure. So even still in this market, you know, we use our money from our business to pay ourselves. The money that we pay ourselves, we pay down our personal debts and mortgages. And when those mortgages are paid down, we have readvanceable mortgages. So every time we pay down the mortgage, it comes back available on the line of credit. We then use that line of credit to buy more real estate assets and then make that equity tax deductible. Because
Hmm.
of course, if you use it for an investment, you can write off the interest. So we take that money, instead of taking that money and putting it out in the market and just buying the asset, we take the money, we pay down our mortgage. So we have lower personal debt, lower personal mortgages, and then take the available equity, again, that readvanceable equity in the home, take that, buy the asset pays for the debt. So, you know, in a lot of these readvanceable mortgages, Manulife, National Bank, that sort of thing, you can compartmentalize that debt. So if I take $100,000 and I buy a house on Westmount, then I'll take that $100,000, I'll put it into a component, name it Westmount, and track the interest separately. Manulife is my favorite product for that, admittedly, and I'll track it because I can create all of these what we call sub accounts where I can see it's like Westmount, Main Street, you know, Smith Street, that sort of thing. Now, in 5 years, or when I'm ready to refinance Westmount or Main Street or Smith Street, I refinance it and I pay off that debt, that personal debt that I've been writing off the interest on. That debt is still available. So now I can acquire something else when, you know, the right opportunity comes available. So I mean, that's really the strategy that I implement for myself and we implement for clients every day. We again identify how much home equity is available, how much cash is available, and then what can that equity or that cash buy you in the form of real estate investments. You know, if you know you have $200,000, that's again, you know, generally speaking, that's 20% down on $1 million.
Yeah.
Can you buy, let's just say you own one primary residence. So you could theoretically buy four more properties. Okay. So can you buy four properties for $1 million? No. Can you buy three properties for $1 million? Probably not. $333,000 each. We're talking in Ontario, let's say, just like, you know, the low hanging fruit that exists in our
Good
local
parts of
communities.
Ontario.
Yeah, yeah, exactly, right. Can I buy two real estate investments for $500,000 each? Yes, you can. Right now, you can. You can like, you know, connect with somebody in Simcoe County, like Colby, for
Yeah.
example. Colby will show you homes in Aurelia right now that you can buy for five hundred
And
thousand
Wasaga
dollars.
Beach.
My client closed on a house in Aurelia, full brick, you know, huge lot in Aurelia, trashed, but in Aurelia for $440,000 yesterday. Fully detached, full brick bungalow. I mean, hey, you can buy two of those. Now, that one needs to be renovated. So maybe what you do in that circumstance is you put the 100 down on that house, you put 100 into renos, and you burr that house, right? You appraise it when it's done, you get your cash back, you buy the next one. But that's the strategy that I use personally and we implement with our clients who are looking to invest in real estate every single day.
Yep. Strategic leverage. I love it. Now, tell us really, how does this go against conventional financial
Oh, that's so easy,
advice?
right? We both know. I'm telling people to use your home equity
Hmm.
and draw against their personal debt. And conventional financial planning and thinking is saying, no, 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 pay the debt off. You don't want any debt. And you know, everybody has heard the term good debt and bad debt. Well, that's exactly what we're talking about. So
Hmm.
if somebody came to me and said, I have $200,000 available in cash to invest in real estate, I'd say, great, what's your mortgage balance? No, 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 I want to buy real estate. I'm like, what's your mortgage balance? Well, we owe 500 on the house. I'm like, great. Take the 200,
Hmm.
put it down on the five. Now you personally owe three. Then we're going to borrow the $200,000 back off your home equity line of credit, make the interest tax deductible, and then go and buy the real estate investment. That is totally unconventional to traditional financial planning strategies that would say pay down your debt, right?
Yep.
You have free cash, just pay down your debt. We're saying, okay, pay down your debt, re-leverage it, use your home equity, write off the interest. good debt, leverage, leverage. That's what we're saying.
I love that. And I believe in
Hmm.
that. So, and I just wanted to reiterate it to people listening because we've been drilled into our brains. Pay off your house. And then that's their investment to fund their retirement. But what if they retire in a time that's like today? And your value, there's no value to your property until you've sold or refinanced.
Yep.
And so it really is up to you to time that market and plan that. But what if things change? And so that's really the most important thing. So I absolutely love that. I think that's such a good piece of advice. Now, if you were starting from scratch today, you had no followers, no capital, no connections, what secret move would you use to get ahead fast?
Oh, I love this. Yeah. So, when you hear that term like standing on the shoulder of giants and finding somebody that's already done it, don't be the smartest person in the room, all of that stuff. That's all the basics. Okay. So, if I was like 27, 28 years old, which is how old I was when I got in the mortgage business without any real estate investments, and I was looking to buy my first properties, my first investments, I would master the basics. So I would first try and find the money that's required for me to buy my first home. It would be my first investment property, right? I would probably seek a joint venture partner, but on a most basic scale. I'd go to somebody like Monica or Nick, and I'd say, listen, I want to buy my first home. I've identified it. It's a duplex, needs some work. I'm going to do the work. I need you to give me my 5% down payment, 25 grand, plus my closing costs, a little bit of rental money. So I need 40,000 bucks, but I'll do all the work and I'll make all the payments. I'll make sure you don't have to worry about anything and you get 50%. I mean, if somebody walked in here today and I sort of like knew them, trusted them, or they won me over, I'd probably do it. Like, I mean,
Hmm.
great. That's a really nice passive investment for me at 40,000 bucks. And then if I'm the younger person, what I'm doing is I'm getting that joint venture partner, and I'm gonna prove that I'm gonna prove myself right, and then I'm gonna house hack it. So I'm gonna put people in bedrooms. I'm gonna put a tenant in the basement. I'm gonna start doing some work on it, and then I'm gonna start forcing the appreciation on the home.
Hmm.
I'm going to paint the outside. I'm going to spend all my time with a paintbrush and a can painting the outside, pressure washing, cutting the lawn, cutting in gardens, making it beautiful. Sweat equity, not stuff that's expensive. Sweat equity. Building the fireplace out of cinder blocks in the backyard with the Muskoka chairs around it. Like build the vibe, increase the value. And then within a year, I'm going to know what that property is worth. And I'm going to research the heck out of methods that would allow me to extract more equity, buy out my joint venture partner, and repeat the process.
I love that. I
I mean,
love that.
it's all the basics, right, Monica?
Yeah, it
Hmm.
is. And we live that and we've done that and we've all been there because none of us started off with money.
That's right. Yeah.
If it wasn't for strategic financing, we never would have gotten our first income property. I didn't even know how mortgages worked
Yeah.
before we
Yeah.
got into real estate investing. I thought we had to buy properties in our expensive area. I didn't even know there was other areas to buy in. And I thought you had to pay cash for the full amount of the property.
Wow.
Like
Yeah.
there's so many options and there's so many ways. And when you have an experienced mortgage provider like yourself, who also is an investor too, I think that really is the secret recipe for success.
Yeah. Thank you.
Sure. Now, what do you see the top 1 to 2% wealthiest people and families doing consistently that the rest of the world ignores or avoids?
Again, all of these strategies exist. It's just like immersing yourself into what they are and how to implement them. So, the wealthiest people that I help, like existing real estate investors with huge portfolios, if they have $200,000 available, they're not going out and buying two sports cars. They're not buying a sports car and a boat. What they're doing is they're putting $200,000 down on $1 million asset that kicks off two or three or $4,000 a month in passive cash flow. Then they'll go out, finance the Porsche, finance the boat, and have the apartment building that they just bought pay for those assets. So they have the apartment building, they have the Porsche, they have the boat instead of just having the boat and the Porsche and the debt. So, you always hear this, right? Like the rich buy income producing assets and let those assets and the cash flow from those assets pay for their lifestyle. That's what I see people doing. Like the most successful real estate investors that I help, that's what they're doing.
Absolutely. Get your assets to pay for your liabilities. Because
Yep.
as soon as you go out and dump $75,000 on a boat, that money is gone. And now you have a depreciating liability, even though on our net worth statements, they're making you declare that as an asset. Most of the
Absolutely.
assets on the net worth statement, like art, you'll have jewelry, you have electronics, they even have furniture. Like, look at the cost of electronics this day and age. You can get electronics, that's depreciated
Yeah.
so heavily. I think it costs more in the 1970s probably than it does today.
Totally.
About it.
Yep.
So it's crazy. Yeah, get those fancy things, but do it smartly and do it through
It
this right way of thinking.
totally. And I see, again, like the richest, most successful real estate investors that I work with, you know what they drive? They drive $125,000 cars that are 6 years old.
Hmm.
Like one of my favorite real estate investors drives a 5-year-old like GMC Denali 2500 that was like $125,000 new, and I bet you he paid 60 grand for it. Now, car to car, if he parks it beside the next one, looks exactly the same.
Yep,
Few subtle changes, but that's it. But he probably paid for it using the cash flow from his assets as well. So the
absolutely.
car's probably in the name of the corp and the cash flow pays for it. And, he sort of justifies needing a big truck because he has all these properties and the maintenance, these sort of things, right, Monica?
Yep.
Yeah.
Different way of thinking for sure.
Right.
This was so fantastic, Nick. Is there anything else you want to share with the audience? I understand that you have a free gift that you are including.
I would welcome anybody to connect with our team. We have all the time in the world for your audience. So anyone that wants to connect with our team, our advice is free. Our consultations are free. You can come to us. We will come to you. We will design and build a real estate investment strategy that's specific to you and your family. Just reach out. You can find us at mortgagewellness.ca. And again, anybody that's looking to implement these strategies and design a wealth building strategy for you and your family, it comes at no cost whatsoever. Our time is free. Please reach out.
I love that. I love that. So, audience, we're going to include that link in the copy of this email along where you're watching this video. And so, all the information is there for you, and you are able to contact Nick and the Mortgage Wellness team. So, Nick, that was so amazing. Thank you
Thanks
so
so much
much.
for
I
having me,
feel
Monica.
so inspired, and thanks for the reminder of why I love real estate and why I
Thank
love
you.
doing what I do.
I always love chatting with you about real estate investing.
Excellent. And thank you, audience, for tuning in. Stay tuned to your inbox tomorrow, where there will be another interview from one of our experts sharing their powerful wealth building strategies to help show you how to fast track your financial freedom. Thanks, everyone.